If you have a mortgage, car loan, credit card, or money in a savings account, then the Federal Reserve's decision on interest rates directly affects your wallet. Right now, in 2026, there's a lot of talk about the Fed possibly cutting interest rates. Some people are saying it will be good for the economy, while others are warning it could create new problems. So what exactly is going on? And more importantly, what does it mean for you? In this video, we'll break down everything in simple terms so you can understand how Fed rate cuts can impact your loans, savings, investments, and overall financial life. Let's get into it. Chapter 1. What are interest rates and why does the Fed control them? The Federal Reserve, often called the Fed, is America's central bank. One of its biggest jobs is to manage interest rates. Think of interest rates like the price of borrowing money. When interest rates are high, borrowing becomes expensive. When rates are low, borrowing becomes cheaper. The Fed adjusts interest rates to control two main things: inflation, how fast prices are rising; employment, how many people have jobs. If inflation is too high, the Fed usually raises interest rates to slow down spending. If the economy is slowing down and people are losing jobs, the Fed often lowers interest rates to encourage borrowing and spending. Right now, in 2026, many experts believe the Fed may start cutting rates. Let's understand why. Chapter 2. Why is the Fed considering rate cuts in 2026? There are a few important reasons behind this. First, inflation has cooled down significantly from the high levels we saw in 2022 and 2023. The Fed has been successful in bringing inflation closer to its target of 2%. Second, the job market is showing signs of slowing down. Hiring has decreased in some sectors, and unemployment has slightly increased. The Fed wants to prevent the economy from weakening too much. Third, the Fed is also watching global economic conditions. Many other countries have already started cutting rates, and the US doesn't want to fall too far behind. Because of these reasons, most analysts now expect the Fed to start lowering interest rates sometime in 2026. But the big question is, how much and how fast? Chapter 3. What happens when the Fed cuts interest rates? When the Fed cuts rates, several things usually happen. Positive effects. Borrowing becomes cheaper. This means mortgage rates, car loans, and personal loans can become less expensive. The stock market often reacts positively because lower rates make stocks more attractive compared to bonds. Businesses find it easier and cheaper to borrow money for expansion, which can lead to more hiring and economic growth. Negative effects/risks. Lower interest rates can sometimes cause inflation to rise again if people start spending too much. It becomes harder to earn good returns on savings accounts and certificates of deposit, CDs. If rates are cut too aggressively, it can create asset bubbles, like we've seen in housing or stocks in the past. So, rate cuts are not always purely good or purely bad. It depends on how they are managed. Chapter 4. How will rate cuts affect you personally? Let's break this down into real-life situations. 1. If you have a mortgage or want to buy a house. Lower interest rates usually mean lower mortgage rates. This can make buying a home more affordable and may also increase home prices because more people can afford to buy. 2. If you have credit card debt or personal loans, your interest payments may decrease over time, giving you some relief. 3. If you have money in savings or CDs, you will likely earn less interest on your savings. This is one of the downsides of rate cuts. 4. If you invest in the stock market, lower rates are generally positive for stocks, especially growth stocks and real estate-related companies. However, the market can also become more volatile. 5. If you're planning to take a big loan, car, education, or business, it might be a good time to lock in lower rates, but you should still be careful about taking on too much debt. Chapter 5. What should you do if rates are cut? Here are some practical steps you can consider. If you have high-interest debt, especially credit cards, try to pay it down before rates potentially rise again in the future. If you're planning to buy a home, lower rates can be beneficial, but don't rush into buying something you can't afford long-term. Review your savings strategy. If your savings account is giving very low returns, you might want to explore other options like short-term bonds or high-yield accounts. Stay diversified in your investments. Don't put all your money in one place just because rates are falling. Most importantly, don't make big financial decisions based only on rate cut news. Think about your personal financial situation first. Final thoughts. Interest rate cuts by the Federal Reserve in 2026 are likely to happen, but the exact timing and size of the cuts are still uncertain. Lower rates can make borrowing cheaper and may support the economy and stock market. At the same time, they can reduce returns on savings and carry risks if not managed properly. The key takeaway is this: stay informed, but don't panic. Understand how these changes affect your personal finances and make decisions based on your own goals and situation, not just headlines. Thank you for watching this video. If you found it helpful, please like and subscribe to the channel for more simple explanations of finance and economic topics. In the comments, let me know, are you hoping the Fed cuts rates soon, or are you worried about what might happen next? I'll see you in the next video. Take care.